Most people assume oil and crypto are completely unrelated, and technically they are. But historically, major oil shocks have triggered economic chain reactions, often preceding some of Bitcoin's biggest price moves, both upward and downward. But why? In this video, we'll explain how oil shocks can influence Bitcoin's price in different ways, depending on the broader economic situation. Before we begin, remember that this video is purely educational and not financial advice. Also, if you enjoy our videos, don't forget to smash the like button and subscribe to our channel. Oil is one of the foundations of the modern global economy. It affects the cost of transportation, manufacturing, agriculture, and global trade. When oil prices rise suddenly, the cost of producing and transporting goods across the entire economy rises with it. Economists call this cost-push inflation. Historically, sudden disruptions in oil supply have triggered some of the most significant economic shocks in modern history. Two well-known examples are the oil crisis of 1973 and 1979. In both cases, energy shortages pushed inflation sharply higher across many economies. When inflation accelerates, central banks often raise interest rates in an attempt to stabilize prices. That tightening reduces liquidity in financial markets, including Bitcoin. And despite often being described as digital gold, Bitcoin has historically behaved more like a highly liquidity-sensitive asset. That means when financial conditions loosen and money becomes abundant, crypto markets tend to expand. When liquidity tightens, they often contract. You probably remember what happened during the COVID-19 pandemic. As the global economy shut down in early 2020, demand for oil collapsed. At one point, US oil futures briefly traded below zero as storage facilities filled up and traders struggled to find buyers. The collapse in energy demand signaled a severe global economic slowdown and raised fears of deflation. In response, governments and central banks around the world launched massive economic stimulus. The Federal Reserve cut interest rates to near zero and injected trillions of dollars into financial markets. Over the following year, Bitcoin surged dramatically, rising from roughly $4,000 in March 2020 to nearly $69,000 by late 2021. The opposite dynamic played out just a couple of years later. After the Russian invasion of Ukraine, global energy markets were disrupted and oil and natural gas prices surged. Inflation had already been rising after the pandemic due to supply chain disruptions, but the energy shock pushed inflation even higher. In response, the Federal Reserve and other central banks launched one of the fastest interest rate hiking cycles in decades. Liquidity across financial markets shrank, and during that period, Bitcoin fell from roughly $69,000 to near $15,000. So at first glance, the mechanism seems simple. Oil prices go up, monetary policy tightens, Bitcoin goes down. Oil prices go down, monetary policy loosens, Bitcoin goes up. Unfortunately, reality isn't quite that simple. In fact, oil shocks do not always produce the same monetary policy response. An important exception occurred during the Iraqi invasion of Kuwait. When Iraq invaded Kuwait in 1990, oil prices surged almost overnight as markets feared a major supply disruption. But the global economy was already weakening back then. Higher energy costs further slowed economic activity, pushing the US into a recession. Instead of raising interest rates to fight inflation, the Federal Reserve began cutting rates to support the economy. So the oil shock still disrupted the economy, but the policy response was different. This highlights two important points. First, oil shocks do not mechanically determine monetary policy. What also matters is the broader economic environment when the shock occurs. Second, higher oil prices don't just create inflation, they also make economic activity more expensive. Businesses face higher production costs, and consumers spend more on fuel and transportation. Over time, these pressures can slow economic growth. If that slowdown becomes severe enough, policymakers may intervene to support the economy through stimulus or easier monetary policy. And historically, that tends to push up the prices of Bitcoin and other cryptocurrencies. Oil shocks do not influence Bitcoin directly. In fact, there is no simple correlation between oil prices and Bitcoin. What matters is the broader macroeconomic backdrop and how governments and central banks respond to the shock. Those policy decisions can reshape global liquidity, and liquidity is one of the most powerful forces driving financial markets, including crypto. So that's it for today's video. What do you think of our analysis? Let us know in the comments below. I'm Giovanni, see you in the next video.